the kind of property that I would want to hold, I can't hold as the CFO of a publicly traded company. The kind of stuff I can hold, sovereign debt, it isn't scarce, and it's a currency derivative. And so Bitcoin is this new thing. It is a digital scarcity that's liquid, that's fungible, that gets commodity treatment, that I can hold on a balance sheet as a treasury asset. And while the currency is not generating a yield and the bonds aren't trading up in asset value and they're generating taxable yield and with a negative real yield, Bitcoin will appreciate in price tax deferred.
A little over a week ago, MicroStrategy Executive Chairman Michael Saylor shared an exciting piece of information on his Twitter account. The billionaire investor announced that the Financial Accounting Standards Board, FASB, is finally allowing companies that hold Bitcoin and other cryptocurrencies on their balance sheet to use fair value accounting principles when reporting their crypto asset holdings. Saylor's news was well received by the Twitter Bitcoin community, earning over 10,000 likes and over 1 million views on the recently rebranded social media platform. During a recent interview with the Bitcoin Layer, Saylor states just how exciting the news is and, most importantly, what it means for Bitcoin going forward. During a discussion, Saylor explains that the board has previously classified Bitcoin as an indefinite intangible asset and generally treated it like a scary exotic asset it wants to dissuade corporations from purchasing. According to the MicroStrategy founder and former chief executive officer, this is the exact reason why many chief financial officers found it difficult to allocate adequately to the leading crypto asset despite its many superior qualities. Saylor highlights several reasons why it will be much easier for corporations to invest in Bitcoin with the new rule change. To begin with, he explains that fair value accounting will allow corporations to report gains and losses on their crypto holdings as gains and losses from investments, separate from their operating losses and gains. He adds that company executives can now freely invest in Bitcoin knowing the rule change allows them to keep the volatility away from their core business. During the interview, the MicroStrategy executive also examines the other types of assets corporations, sovereign wealth funds, family offices, and other big money investors currently choose over Bitcoin largely because of regulatory issues such as the previous FASB accounting rules. Some of the more common alternatives among institutional investors include cash, equities, and treasuries. Saylor says each has huge flaws that make them completely incomparable to Bitcoin, especially as they all yield far less than the rate at which the dollar is getting depreciated yearly. We will now bring you clips from the interview. But before we do, please take a little time to smash the like button, subscribe to the channel, and turn on post notifications for more videos like this. Also, make sure you drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The significance of fair value accounting coming to Bitcoin is it makes the asset non-toxic for an operating company to hold or a company that uses GAAP accounting. It also makes it transparent, the performance of Bitcoin-backed companies to be transparent. And so that's a positive feedback loop, right? When Bitcoin companies are performing well, it'll be obvious to Wall Street and they'll want to finance more of them, right? So that's a secondary benefit. And the third is because Bitcoin is a commodity, it's a financial commodity, it can be held on the balance sheet of an operating company where right now only treasury assets or sovereign debt type assets can be held on that balance sheet as a treasury strategy. So before Bitcoin, there really wasn't any good fungible commodity that I might hold on the balance sheet. My choice was securities or property, but I can't really hold property on my balance sheet if I'm a corporation because it's not liquid. I can't buy $247 million worth of property a week and then liquidate $121 million in an hour, right? It takes me 6 months to buy a building, and it takes me 3 months or a year to sell the building. So that doesn't really work so well as a treasury asset. And then packages of securities are fungible and they're liquid, but securities are discriminated against by the regulators. And if an operating company holds more than 40% of its liquid assets in securities, it's deemed as an SEC 40 reporting company or a financial company. And once it gets deemed or designated as an SEC 40 company, the operating executives lose the rights to do many things that operating companies need to do, like issue debt, take on leverage, issue options, sell volatility, etc. The treasury strategy of an operating company is we want something which is liquid and fungible and low risk. So traditionally, the most liquid, fungible, low risk financial asset is just the dollar. The local currency, maybe the euro, maybe the dollar. And so that's the obvious thing to do. I collected $100 million this month. I put it in the bank. Now the problem with that is that the dollar doesn't generate a yield, and the dollar is a depreciating, debasing financial asset. So in a world where the dollar gets inflated 7% a year, if the money supply of U.S. currency increases 7% a year, and it has over the past 100 years, then $1 billion in cash is going to cost you $70 million a year in purchasing power. And of course, at 7% a year, over the course of 10 years, you'll cut your asset value in half. So it doesn't take a rocket scientist to figure out that a treasury strategy based just on currency isn't awesome. It's dilutive. The question here is, what's the next best thing? Well, the next best thing is sovereign debt. Sovereign debt is debt issued by a government. So you've got the most creditworthy counterparty, maybe the United States government. You don't really think they're going to default. And that's the advantage of sovereign debt. You might take on duration risk. If you buy long-term bonds when the interest rates are low and interest rates go up, then the bond will trade down and you could get wiped out that way.
Going further, Saylor explains that even short-term government debt obligations carry a lot of risks. He gives an example of 3-month T-bills yielding about 500 basis points, adding that they might not come with credit default or duration risks, but they are taxable. With taxes, 500 basis points become 300 or 350 basis points, just about half of the 7% annual depreciating rate of the dollar, and far lower than what any respectable company is expected to make if it wishes to survive. Investing in equities does not look any better, Saylor adds. Outside the top companies in the S&P index, for example, other companies run a number of risks, from competitive risk to embargo risk, war risk, tax risk, labor risk, etc. According to Saylor, these various investment risks are the reasons why corporations like Apple either dividend out the cash flow, do stock buybacks, or do acquisitions to park away the cash flow in something profitable. However, he adds that Bitcoin presents a much simpler, more profitable, and less risky option. Here are more clips from the interview.
So the existing rules, they force everyone to make irrational decisions, take on debt they shouldn't take on, buy companies they shouldn't buy, issue dividends they shouldn't issue, and buy back shares they shouldn't buy back. And the significance of Bitcoin is in two ways. First of all, CFOs and CEOs starting in 2024 will now have the option to buy Bitcoin instead of buying treasury bonds. So now you can buy a commodity that's liquid and fungible on your balance sheet. And that commodity is a scarcity. And because it's a scarcity, that means you can expect it to accrete in value more than 7%, probably 14% a year over the long term, even after, I think after we've gotten through the bull run and after the early adoption boost, which will cause Bitcoin to appreciate at rates faster than 14%. In the long term, over the course of 100 years, starting a decade or 2 decades from now, you could expect it to appreciate at 14% a year if the money supply or the currency supply is appreciating at 7% a year or expanding at 7% a year. So you've got an asset which will appreciate in price versus fiat. And of course, bonds don't, right? Bonds never appreciate in price for the most part against fiat. You're buying them at par in order to get the taxable yield. So that's that's a big deal, right? It's not comparable to buying a portfolio of soybeans or silver or gold or oil or natural gas, because those are true commodities. And the problem with commodities, and Bitcoin doesn't have this problem. This is why people have to, we should really call it a scarcity rather than a commodity. The problem with commodities is there's a dysfunctional, systemic, endemic inflation built into the system. Not only is it possible for someone to create more oil, it is a certain thing that when the price of oil triples, they will create a lot more oil, and no one is concerned about keeping the supply of oil in check over the long term. There's this dysfunctional competition. You can try to create a cartel like OPEC, but people that aren't in the OPEC, like the frackers in Texas, they're not in OPEC, and they're going to frack oil, and they're going to bust that cartel. And all of these commodities find their cartels broken, and the gold miners want to produce more gold, the silver people want to produce more silver, soybeans want to produce more soybeans. So commodities aren't scarce. There's never been a commodity like Bitcoin that was scarce. The closest thing to something like Bitcoin would be acreage in Palm Beach or acreage in Miami Beach. Not the square footage, but rather the underlying dirt. Because there's only so many linear feet of beachfront property in Palm Beach for the last 100 years. And no amount of money printing, and no amount of capital, and no amount of technology, and no amount of manufacturing know-how creates more beachfront property in Palm Beach. So when you look at that scarce, desirable property that you can't create more of, you can see that actually does go up in value. That's gone up by a factor of 1,000 in the last 100 years, 1,000x. And that appreciates at the rate that the money expands. But the problem is, it's not a treasury asset.
According to Michael Saylor, the only other investment instrument comparable to Bitcoin is buying a beachfront property somewhere in Palm Beach. However, such an investment is not as liquid or easily convertible to cash as Bitcoin. So every other alternative falls short of Bitcoin's many important qualities that make it very attractive for corporations. Saylor describes the leading crypto asset as a new thing, a digital scarcity that's liquid, fungible, and gets the treatment of commodities, but with more advantages than commodities like gold and silver. What are your thoughts on Michael Saylor's interview and the FASB rule change? Do you agree that it will make Bitcoin more attractive to corporations and other big money investors? Please drop your comments and observations in the comments section below. Also, ensure you subscribe to the channel, turn on the notifications bell, and give this video a thumbs up. Thanks for watching.